Good morning, good afternoon, depending on where you're at. Good evening for some of you guys across the seas. I hope you guys had a great weekend so far. Let's go ahead and talk about what's happening right now within the markets, as well as, in particular, SPX. We'll do an update on the challenge, and then if we have time, if my kids are still down, let's dive into maybe some potential trade ideas going into next week. Hey, great to see you, Benari. Frank, you as well. Hope you're having a good weekend. So let's talk about SPX here. Let me make the weekly chart bigger. So the weekly chart is something that we've been diving into here for the past few weeks. Certainly my simpler folks have known that this has been a chart I've definitely been keeping a close eye on, in particular for SPX. And the reason why is because 4,300 overall has been trying to hold as support. Funny enough, 4320 was actually the max pain level for Friday last week as well. But when we zoom in here, right, we can see that the last several weeks we've been able to open and close the bar still above 4,300. So it means that even though we saw some moves throughout the week below it, that was still acting as an overall big support level. And I mentioned last week, if we continue to hold that, right, that's a good sign that that's still trying to maintain support, that we could still either potentially see chop or maybe eventually we could get a bounce back up into resistance or higher. However, if we could not hold that, right, that was a better sign that we could continue to trail down and maybe go down to our next big support level. So what was interesting is for those of you paying attention to pre-market on Monday, we were way down, right? Futures, all of that. It was like crazy down, well below 4,300. And then going into the open Monday, we saw those futures start to crawl back. And they crawled back so much that we ended up opening the week at 43.2701, basically at the high for the week. But we opened it about that level, right? So the fact that that was still open at the start of the week, that the bar printed that, means that the real clue was going to come in on Friday. Whether or not we could then bounce back up into the close of the week and still end up trading around 4,300. Like I mentioned, the max pain was 4,320. And at the start of the market, we are actually bouncing up on Friday trying to get there. Let's pull up the daily chart really quickly. Right, so at the open of market, we are actually at 42.91. So we weren't too far away from that level. We were at resistance of the 10-period simple. But for myself, I know that I put on a few trades there because I thought, okay, maybe that's where we'll end up going, right? Nothing for the challenge account here. But I know that I kind of had myself still evenly weighted on both sides because that's a big, strong number. Instead, should have taken the profits at open because we weren't able to maintain it, and we ended up selling off for the rest of the day and ended up closing around 4,200. Now on the daily chart, this overall is a pretty nice bearish setup. We have the trend that is bearish. We went right into resistance once again with this bar and ended up closing as a bearish divergent bar. So that's a good sign that we might follow through with a lower low. And of course, bearish divergent bars and bearish trends usually have a good follow through rate, right? Just like for the majority of the time in the market, because it's overall bullish, we usually look for bullish divergent bars and bullish trends. But for this one, we're looking at bearish divergent bars currently. When we look at momentum, that is starting to move lower with room to the downside. We have the bearish signal and the compound breakout tool, and we do have a low compression squeeze forming, so that's a good sign that, this might start to roll over and move down. Now there is, just like we saw at 4,300 on the weekly time frame that's been trying to hold support, 4,200 on the daily chart has been a level to be mindful of, right? One of the things, if you've been trading this market successfully this year, right, one of the things that you may have noticed, or certainly I've noticed, is to be mindful of the levels. And certainly right now it feels like on SPX it's like $100 levels on the daily chart, right, on the weekly chart that we're looking at. So a few weeks ago, the main levels that we were trading in between were 4,400 as resistance and then 4,300. We talked about that last week even. This past week, we tried to hold 4,300, weren't able to do it, so that ended up being our resistance level. What used to be support, right, turned into resistance. And then 4,200 turned into our new support level. But once again, just a 100-point range we basically kept chopping in for the most part throughout the week. So the question, of course, is with this bearish tone, and we'll flip back to the weekly chart to round this out, but if this does end up following through with the move lower, right, is it going to be 4,200 that now acts as resistance and 4,100 that is support for next week, and those are the ranges that we trade in between? Or are we going to see maybe a bit stronger of a flush? Let's go back to the weekly chart. So on the weekly chart, really quickly, when I zoom out, you can see on the momentum on the awesome oscillator that there's plenty of room for this to continue to the downside, right? For the pandemic, for example, we saw where that exhaustion finally hit. It was nicely in line with the true lows here, and then we got that strong bounce back up. Right now, we're not near exhaustion, and on SPX, we still don't have the weekly true lows that I would like to see to kind of confirm, okay, this might be the discount price to buy back in this market. Certainly, the compound breakout tool is still bearish, leaning towards a pullback into the next support level. And we still have a weekly squeeze, which, certainly right now looks like it could start to fire to the downside and maybe bring us to that next target. So let's zoom in and talk about that. Up here, right, 4,300 was that main level we talked about. We do still have back-to-back divergent bars here, which was a sign of chop, but the last divergent bar to print was bearish, and notice how we certainly got the overall follow through on that lower low into this week. We see the Bollinger Band starting to flare open to the downside. We already talked about the momentum and bearish sentiment here. So what's kind of the next target? Well, on the weekly and monthly time frame, the next true support level here with the 100-period simple on the weekly is around 39.26, and on the monthly chart it's 39.14 with the ATR trailing stop. So we have like kind of a level around 39 and change, right? But I think the bigger next target to play to the downside is actually 4,000, right? We've seen sometimes where the price will go down towards the support, never quite touch it, and then it bounces up, right? We've seen that plenty of times without the market itself that indexes certain symbols. So I wouldn't think that would be too uncommon to potentially see here. Plus, 4,000 is a very strong psychological level. So if we don't trade within that 100-point range of 42, 4,100, right? Maybe see that similar chop just stair-stepping down, and we do really start to get a sell-off, there is going to be a little bit of support around 4,100 because we did see 2 weeks ago the low was 41.14, so that is going to be a slight level to respect. But ultimately, 4,000 is my big target to the downside if this really does continue to sell off here. So, and then we'll see, right, of course, how it reacts around that level. So if we had closed at 4,300, we would have actually made a bullish divergent bar for the week. That would have, continued to bleed into the narrative of chop, of us trying to hold that support level. But the fact that we weren't able to, the fact that we closed this week closer to 4,200, this, to me, it's starting to agree with the daily chart in the sense that we could continue to get a stronger pullback. Now, the one thing to remember in this market, of course, is news can completely change the narrative. And next week in particular, we have the Fed announcement, right? We're anticipating the rate hike. The question is, how much of one are they going to do on this first one, right? We've heard the narrative of, if you listen to the news around that stuff, right, we've heard a few different narratives that are kind of out there. Part of that rate hike is obviously already priced in with this move down. But the question is, did it price in the full amount of whatever they're planning to do, or is it going to be a bigger one than the market was anticipating, and in turn we continue to react and pull back to the downside? That could be a possibility, right? That news could be the catalyst for the pullback. At the same time, right, we have everything happening geopolitically, and of course the Fed's watching this, so if they kind of ease in a little bit, right, if they kind of pull back next week, or if we get any sort of news that things are leaning towards peace with Russia and Ukraine, and that's trying to get resolved, then of course that could end up being the catalyst for the pop-up in the market. So we still want to be, no matter what, mindful of the capital risk that we put out there. That is the best way to protect yourself from blowing out your account in this kind of market. if you end up getting stuck right on either side of a big move, is the first way is to always be mindful of your capital risk. And you should always do that no matter what kind of market you're trading. But that's first and foremost. And then certainly the second thing, and we talked about this last week, is, potentially playing both sides of the market, of course, right? Playing the bullish and the bearish sentiment throughout the week and understanding that you're just playing up into those support and resistance levels and trying to take profits that way. So that's another way, of course, to take advantage of this market. But I think it's certainly going into the close last week, it's not looking too good here. So unless something turns around from that news, right, either midweek that we are already anticipating, or if something else comes out, to me, this looks like it's still overall just trying to bleed lower down into that next main support level overall. And keep in mind, of course, we've talked about this plenty of times on here and at Simpler, but for anyone new listening, or if you just want that reminder, right? On the monthly time frame, we've been at exhaustion for quite some time. We've been trying to see it print a red bar from all the way back in October last year. So we knew that some sort of consolidation or pullback might start to occur just from the technical side of the monthly chart. And so we're starting to finally get that exhaustion. We're getting the pullback signal. And keep in mind, right, the monthly time frame is still very much in a bullish trend. It just, if anything, right, if we were to see this on a daily time frame and intercept that chart there, we'd be like, oh, we've had a great run up. It's probably going to consolidate. And as long as support levels hold, I'm looking to buy this for the next bull run. So to me, right, it kind of feels like this is what we could see from 2015 to 2016, where it just chops and then everything gets a nice reset. We build in a squeeze maybe, and then we go from there. That's what it feels like right now. Now, like I said, geopolitically, there's a big difference between what's happening currently and what happened in 2015, 2016. But we'll see, right? We'll just continue to play the technicals as we're looking at them. And right now, to me, it looks like overall chop, but I understand that monthly support level, right? That next weekly support level is down around 3,900, 4,000 in that range. So I definitely need on the daily chart to be okay with a bit more of a pullback if that happens. So that's SPX, right? That's what it looks like overall in the market right now. But let's move on to the challenge. So let me bring that over. So here's my challenge account. Just did 3 trades last week. We did one in Tesla and then we did 2 in SPX. So let's pop up the Tesla one first. I was a little frustrated about this one, to be honest, because the move followed through perfectly, and maybe some of you guys were able to take the profit or take it quickly. Keep in mind, you should always do what you think is best for your account. But unfortunately, a few things happened that worked against us on this trade, and I wasn't able to take the profit immediately off the table. So let's talk about it. Here was the setup. We had a great bearish divergent bar and an overall bearish trend. So all of that looked good. I tried to jump into this a little bit earlier, and then it just kept like running away. So it is what it is. Maybe I paid a bit more. Maybe that was my first mistake, if you will. But I really liked the setup. Everything looked good. And of course, on Tesla, we also had some intraday squeezes setting up that looked like they could move lower. So all of that looked good as well. And then the next day, we did follow through with that lower low. We tried to move a bit lower, but what happened that day? Well, Biden came on and he started talking about the oil and energy sanctions and sanctions in general and all that stuff. And of course, if you're Tesla, right, and you make electrical vehicles, no matter how you need to, use energy to make that or anything else, the idea, of course, is, oh, you don't need petroleum in order to fill up your car. Therefore, you might be able to hold out a bit better in this market. So that narrative kind of helped bring up Tesla a bit more compared to the rest of the market. The other thing from a technical standpoint was the 800 level. That's what I was personally watching whenever I was like, ooh, it looks like it's trying to bounce back up. Let's go ahead and take the profits, or just, protect capital. And the reason why is because 800 back here, right, and back here, it's been trying to act as a price support level. It's a very nice psychological level. Now, going into next week, I don't know if it's going to hold or not. But that is a level that tried to maintain, and it certainly was able to last week. So that's what helped cause this kind of bounce back to the upside. All we did was go into resistance and then we started to sell back off. You might have been able to protect capital Friday. I was looking to see if it could get a bit more of a reversal because at the time, right, when you looked at it Thursday, it already looked like it was going to be a full loss. So I was like, okay, I'm already going to look to make this up with SPX trades, so I'll take it if I have to. And I set out an order to try and close it out closer to break even or a small profit, but obviously we didn't get enough of a move down. Our low ended up being only 793. Our broken wing butterfly was closer to the 780 strike. Right? So it started to gain in a little bit of value. You might have protected some of that capital, but otherwise ended up being a loss for the week on the 156. So unfortunately, that sometimes happens, of course. But the idea is that, first of all, our winners offset our losers, right? Because you're always going to have losers in trading. If you meet somebody who has a 100% success rate, let me know. I'd love to meet them and talk to them, but it's very unlikely that you will ever meet somebody that's 100% a winner, right? So first of all, if you're a new trader, you're just going to have to get past that psychological hurdle. And once you do, you're going to be a much better trader for it because you'll understand that the whole point at the start of the trade on keeping and being mindful of your risk is really what's going to help you in the long run on not blowing out your account and actually seeing it grow. So the second few trades were on SPX. One second. My son's starting to wake up. Okay. So we did two more trades in SPX. The first one was on Wednesday, going into expiration. It was March 9th. And let me just widen these out. Okay, here are the strikes. So it was the 4280, 4270, 4260. It was a standard 10-point butterfly. It only cost us about 90 cents. The reason why I wanted to do it as a standard is, of course, we are opening a bit closer into the close, so I wanted to keep that capital risk small. So 90 cents, right, on a 10-point spread, not a bad risk versus reward. But also the 10-point spread encompasses a much wider range. So it allows you a little bit more forgiveness factor if the price doesn't quite meet up at like 40, if it's like right on the edge of, for example, 42.75, where on a 5-point spread, you still might end up with the loss. The 10-point spread gives you that forgiveness of that possibility. And so the reason why we set this up is SPX at the time was trading closer to 4,300. It was having a hard time breaking above that level. And so because of that, we took a look at the max pain and the profit recycling mastery, and the max pain was around 42.75. So I originally looked at making this trade around 42.75. But the price started to get away on me, and I was like, I don't want to risk that much capital. So I moved it one strike set down to the 42.70. I made sure to keep it a 10-point spread so I could really encompass that range. And then going into the close, we ended up closing right around 42.77.88. So certainly it was closer to that 42.75 range, but this is why I liked the 10-point spread, right? The 10-point spread still encompassed that level and allowed us an overall profit. So SPX, the benefit of this is that you can let it cash settle. I know some of you guys day traded this and locked in a very nice profit, so well done if you did. But if you're like me and you let it cash settle because you didn't want to use your day trades, totally understand. We ended up walking away with a cash settlement of $2.12. Of course, that minus our 90-cent profit or 90-cent cost basis is, let's just bring it over, right? So 212 minus 90 cents was a $1.22 profit, right? Certainly above 100% return on our initial risk, not a bad profit to lock in. And of course, that in itself encompasses the majority of the loss that we would be taking on Tesla for the week. So not bad, right? The next trade we did was SPX, and this time we did a broken wing butterfly. We were able to open it a little bit more quickly going into the close so that capital risk wasn't, too much building into the trade. And we did the 42.20, 42.10, 42.05. The reason why I chose those strikes is, of course, SPX was really selling off into the close. And just like we did with Wednesday, right, part of the reason why I chose those strikes is the idea that, let's say we continue to sell off, but then we go down to 4,200, we see some profit taking, and the price bounces back up. 42.10 kind of encompasses that range, but at the same time we did a broken wing butterfly, so that way if the underlying price goes completely in the money, it still allows for a profit. That's what happened. We went completely in the money. The price closed at 42.04.31. So it settled for a $5 profit overall because it's a 5-10 point spread. 5 minus $1.35 ends up being a $3.65 profit potential. So the two profits on SPX completely covered Tesla. We're actually back to positive overall for year to date on SPX. I was a loser last week, so we are back to being positive. And overall, we're up the year $672. So not bad. We'll continue to look at more trades next week, but I do have to go. My kids are up now, guys. So thank you so much for joining me on this update. I hope you guys have a great rest of your weekend, and I'll talk to y'all again next time. Bye.